Hi, student. This is Professor Bonaparte. Today we're going to talk about elasticity. Elasticity in economics is a big topic. The idea, if you change a price, how change a price means you change a policy. How that impact the demand or the supply or the demand of other goods or your supply, labor supply or other things. So elasticity is a big deal in economics. So how we define it, elasticity measures how much quantity demanded or supplied responds to changes in the price, income, or other good. Change in the price, income, it's a policy, government policy, or shake up in raw material become to be more expensive. Tariffs, import, export impact, subsidies impact prices, and therefore we need to think about elasticity. How to do the formula is suppose you move from price 1 to price 2, change your quantity from Q1 to Q2, and then the formula is Q2 minus Q1 divided by the average, P2, everything divided P2 by minus P1 divided by the average. You will have an Excel with illustration of demand. Suppose the price was 15. At price of 15, the quantity was 22. Now, for whatever reason, the price went down to 12. And then the demand became to be 37. So when the price went down, there's more demand, the quantity here, more demand. So that's an inverse relationship. The lower the price, the more the quantity. And then if you can calculate the revenue here, you can see like 15 times 22, that would be 330. But if it's a 12 times 37, it's 444. So when the price going down, more quantity, but the revenue is bigger. So for elasticity, what is that elasticity? We say the change in the quantity divided by change in the price. Well, that's a change in the price, which is P2 minus P1, which is D7 minus D6. I'm looking here. And this is a change in the quantity. And the elasticity is a quantity divided by price, which means the H6 divided by G6. That will give you the elasticity. The number is 2.28. What does that mean, 2.28? What does that mean? What about 0.6 or negative? So what does that number means? If it's above 1, that means elastic demand. If it's below 1, it means inelastic demand. If it's equal to 1, means unit elastic demand, elasticity. So what does that mean? We're going to go to the slides. So this is a formula, elastic and inelastic. And this is how to calculate that. So here's example. What is that? Perfectly inelastic demand. This is perfectly inelastic demand. An increase in the price leaves the quantity the same. Inelastic demand at 22% increase in the price lead to only to 11% decrease in the quantity. So we call this an elastic, 22 versus 11. Here, unit elastic means change in 22% in the price cause 22% change in the quantity. In this case, the revenue will be the same. Here's example. If the quantity went up to 30, for example, how about 28, 27, maybe 27 and 5, maybe. Yeah, so if the price 15, you get 22, the quantity. If the price going down to 12, the quantity becomes to be 27. In this case, that's a slope. The revenue is the same. And the unit elasticity equal to 1. That means unit elastic. That means the revenue doesn't change. So this is the case for revenue doesn't change. And you have other things. You have elastic demand above 1. And then you have perfectly elastic demand like this. And this is how we calculate the revenue. If this is the price, this is the quantity, P times the Q, price times the quantity equal to revenue. If you change the price from A to B, so $5 at 90 for 50, but if the price going to 4, you sell 100, that will be 400. So you go from 450 to 400. Let's say this is another example of revenue. You can have also same line with not curve. Usually demand is curve. But if it's not curve, you can have elasticity larger than 1, elasticity smaller than 1, and only 1 point, the elasticity is unit elastic. And that's in the continuous case. And you will have these slides in your work. And here's example for demand schedule. And you can see elastic, elastic, elastic. Unit elastic, there is 1 point. and then you become to be inelastic. So the elasticity of demand, there's a relationship between P and TR. P is a price, TR is total revenue. If the P and T are going together, that in the sense up or down, that means inelastic. If the P and the going up, if the P going up and the T are going down, that means the price going up and the revenue going down, that means elastic demand. And if the pricing change, the revenue doesn't change, that means unit elastic. Now we're going to talk about another type of elasticity, income elasticity of demand. The formula is YED equals change in quantity demanded divided by change in income. So there is normal good, inferior good, and luxury. So what does that mean? There is another income, another tab here called income elasticity. Suppose your income was $100, moved to 105, they give you a raise in the company. So your income went up 5%. If your demand for good X, product X was 60, when your income was 100, your demand 60, but when you're raising your income, you have a more demand, you like it more, so you have more money, so you can buy it more. So you go down 6.7. So in this case, elasticity equal income elasticity, which is the demand for X, which is percentage change 6.7 in this case, divided by 5, it's above 1. Above 1, that means a luxury good. If it's a 58, for example, then it's a negative. Negative, that means inferior good. So the more you have income, the less you can consume it. If went up to 6.1, for example, 61, it's positive. That means normal good. So normal good, if it's above 1, become to be luxury good. And here you have example. If consumer income rises 5% and the demand for luxury rises 15%, so 15 divided by 5 is 3. That means luxury good. Cross elasticity, for example, tea and coffee. If you like coffee and you like tea at the same time, sometimes you drink coffee, sometimes tea. So there is some cross price elasticity. So the change in the quantity demanded for good A as a change in the price of B. So there's substitution, complement, and unrelated. So here's example, cross elasticity. Suppose the price of tea is 10, and then you consume 60 coffee. Consuming. Okay. Okay. Consuming 60 cup of coffees. Now the price of tea went up to 11. As a result, you didn't change anything. You still have 60 coffees because you didn't care about tea. You only drink coffee. In this case, the cross elasticity is 0. That means unrelated good. Doesn't matter what happened in the tea business. Your consumption of coffee is the same. But if the price of tea becomes to be more expensive, as a result, you start buying more coffee, like 67. You like coffee and tea, but now tea is very expensive, so you start drinking more coffee. So the elasticity is above 0. That means a substitute. So more when tea is expensive, you have less tea and more coffee. So that's a substitute between coffee and tea. But if you start become to be 58 or 54, for example, so in this case, oh, no, not 54. 54, then let's make it 56, for example. So the cross elasticity is negative. Negative, that means a complement. So when you drink less tea, then you also drink less coffee. So that, for example, could be like a burger and Coke. The more when burger become to be expensive, you eat less burger and you drink less Coke, for example. That's become to be a complement, that with the others. All right, the next one is supply elasticity. And here's your example for cross elasticity. If the price of tea rises 10%, the demand for coffee by 8%, then that's a substitute because below the 1. Supply elasticity is simpler than others, actually. So what is that supply? You go to the producer, at price of 10, they want to sell 30, but if the price going up, if you stop importing from China, the price come to be up in America, in the United States, then you want to sell more because you can do more profit at 50. So if the price at 10, your quantity you produce 30, At the price of 11, you expect to produce more to 50. So your revenue at 10 is 300. At 11, it's 550. So what's the elasticity? Here's the equation. Q2 minus Q1 divided by the average Qs, everything divided by the B. This is the price differences, and this is change in the price. This is a change in the quantity, which is based on this formula. Q2 is number 2 minus number 1. This is Q1, Q2 here. So that means that's a Q2, Q1, and that's elasticity. If it's above 1, supply is elastic, equal to 1 unit elastic, and below 1 is inelastic. And here is some figures if you want. This is the formula. This is another example. And here is inelastic supply, perfectly inelastic, inelastic supply. That's perfectly inelastic and elastic. Here, unit elastic supply, straight curve. Here, elasticity is greater than 1, and here, the price elasticity of supply, perfectly elastic supply. Here is unit elastic, could be less is small and greater than 1, less than 1, but there's 1 point here is unit elastic. So here's application. Can good news for farming be bad news? When the weather is good and you have a lot of crops and a lot of raining and you have a lot of crops, you think it's a good season. No. When you have a lot of tomato in the market, you put it in the market, the price of tomato going down, then you have less revenue. So in this case, if the harvest was good, you're going from S1 to S2. So yeah, you sell more, but the price is much less and the revenue will be less. And there's also application for the oil. When countries produce more oil, the prices drop a lot, but they sell a lot, but that doesn't mean they have more revenue. And here are example for oil market or others when the supply moves up, the price going down a lot, and the quantity. Here in this example, if the supply is less, if you have a war in the Middle East, the supply is less, so the price going up and the quantity is less, but you have a more revenue. Here the opposite. You have the long run when supply and demand are elastic, a shift in supply cause less revenue. Now I'm going to talk about government tax and revenue. I want to stop here a little bit. Hey, people talk a lot about cut taxes is good for the economy, cut taxes, which is good, make you more extra money and things like that. But bad for the government, they might have less revenue, and that means they have a deficit or debt. So we're going to analyze that. So don't listen to the politician when they say it's good, let's cut taxes, it's going to be good for the government. No, the government could be good, could be not, but we're going to see the elasticity. So government tax and revenue, the effect of taxation in good depends on the price elasticity. Example, if the demand inelastic, a higher tax will generate more revenue. If the demand is elastic, higher tax may reduce revenue. So what does that mean? Let's go to the Excel. So suppose government tax. Suppose the corporate tax is 20% as of now, corporate tax is 21%. Corporate profit is $100, so you tax them at 21, that will give you a revenue $21 or 21 trillion or 21 billion. Now, hey, everybody, just wanted to let you know, the US corporate tax is at 21%. That's true. I'm January 25 now. But the effective tax for corporate is not 21, it's 17, 16, some corporate 15 or 18. So let's assume this is the effective one, but the effective usually less. So yeah, the 21 corporate profit 100 will be revenue 121. So the government say, okay, I'm going to give the army 10 billion or 10 trillion, maybe 5 for healthcare, 3 for education, 2 for social security, and 1 to help other countries. So that's 21. Your surplus deficit is 0 because your revenue from corporate tax budget 21, this minus this, 0. Now you're running for a president. You're gonna get votes. You're gonna tell corporate, hey, rich people, give me your money. I'm gonna cut the tax in corporate. But then you're gonna tell the poor people, hey, we're gonna cut tax in corporate, but they're gonna have more economy, so we're gonna have more revenue, and we're gonna give it to you, poor people. Let's see that. If you cut it from 21 to 15, that means you drop it by 6 percentage point. That will be a drop of 33% in your tax, government corporate tax. So if the corporate income, the profit was 100 because you cut the tax, you have more activity, which is true, it should be more activity. And then the corporate increased 20% activity. So they went from 100 to 20%. That's awesome. But the change for corporate, if you calculate, so this is government revenue. If you divide this by this, it will give you elasticity 1.8. In this case, you have a deficit because 15% multiplied by 20, that will be 18. Um, so let me get that here. So this is corporate profit elasticity. This is tax revenue elasticity. So 18, 21, you still have the same spending. Here is 18, here is 21. The surplus deficit is -3. So you have a deficit basically. So if the politicians say, look, the corporate went up 20%, yeah, 20%, but your tax is much less than the growth of the companies. If the corporate went up to 140 in this case, well then yes, 21, your revenue is the same, 21 your budget, surplus of zero. If the corporate go up 60%, 160, then yes, you can have a higher revenue here. And then yes, if you cut taxes, good for corporate. But usually the corporate go to 120, like maximum 20%. And usually the government spend more. So they will spend $15 in the army in the next year. Healthcare, maybe six, things like that. Their spending is 26, their deficit is -8. So why I care about this? Well, if you look to the website here, I have a website and you have the link here. As of today, the US debt is 36 trillion, almost half. Every 30 seconds, we'll add 1 million here, like 954. Every 30 seconds is going to be 955, which is 1 million. Okay, that's one. Well, okay. Boom, we got 1 million here. Every 30 seconds, 1 billion. But if you look here, the US federal revenue is about 5 billion. And every 30 seconds doesn't add to 1 million, less than 1 million. So there is a gap between the government tax revenue and the spending. And here's a link for the website if you want. Like I'm done, but here's a summary for elasticity. Price elasticity measures the response to price changes. Income elasticity measures the response to income changes. Elasticity help business and policymakers make informed decisions. As for government, elasticity is a key concept in economics that affect price and taxation and market dynamics. Your homework. Your homework, or what I want you to do, you see this blue? I want to change this and look at the elasticity. I have the formulas done for you here and here. You don't need to do anything here. So the software does it for you. So change this and see how the elasticity change and try to say this is elastic, inelastic, or unit. Income elasticity, change this and see the number here and then see. So play with this a little bit, change numbers and tell me it's normal good or inferior good or luxury good. The cross elasticity, the same here. So change this number and look to this number and tell me substitute complement or unrelated goods. Supply is the same, change this, look at this. Elastic, unit elastic, elastic or inelastic. Government revenue the same. If you change the corporate, how much change this? Now I did here some fancy things here, but you can also do, you can just take this one and 20% change. I try to be fancy here with this one, but you can just use those and this will be government elasticity basically. Can be here without being fancy. Just a 20% change here versus 33% change here. $120 minus 100 divided by 100. So this is elasticity without being fancy. I want you to use this one. So let's do here, no color. Just use this one. That's fine with me. Your homework is here. Create a video, go to the each tab, try to change one of those, and do on what you learn from it. So for example, you change this to 58, then what you learn. So it's below zero, inferior, good. Then do it, for example, 67. So what you learn. So just go tab by tab, make changes, and put that in your videos. Say, hey, everybody, my name is X. I'm gonna analyze elasticity, go to demand, supply, demand, income elasticity, cross elasticity, supply elasticity, and government elasticity. That's all I'm asking you. So thank you so much. Just go create a video for demand and everyone, change a number, look to the elasticity. What are the key inference? Thank you so much.